For over a century, when investors wanted safety, they bought government bonds. U.S. Treasuries, German bunds, Japanese government bonds, the bedrock of every conservative portfolio. But something extraordinary is happening in 2025. A digital asset with no government backing is challenging the world's safest investments and winning. Bitcoin now delivers a sharp ratio of 0.96 compared to treasury bonds at just 0.3 to 0.5. That means Bitcoin gives you nearly double the return for every unit of risk you take. For the first time in financial history, smart money is asking, why buy government promises when you can own mathematical certainty? In the next 4 minutes, you'll discover why legendary investors are abandoning century-old safe havens for a 13-year-old digital asset, how rising sovereign debt is creating the greatest bond crisis in modern history, and why this shift could reshape global finance forever. The numbers tell the story of a financial revolution in progress. BlackRock's Bitcoin ETF became the fastest ETF in history to surpass $70 billion in assets under management. It took just 341 days, 5 times faster than the previous record holder, the gold ETF. Meanwhile, traditional safe havens are cracking under pressure. U.S. government debt has exploded to $36 trillion, representing 123% of GDP. Japan's debt-to-GDP ratio exceeds 250%. Germany lost its last AAA credit rating. The very foundations of sovereign bond safety are eroding. Consider the Wisconsin State Investment Board, one of America's largest pension funds. In early 2024, they allocated $163 million to Bitcoin ETFs. By year's end, they had doubled down, expanding their position to $321 million. This isn't speculative gambling. This is institutional recognition that the rules of safe investing have fundamentally changed. The transformation extends beyond individual investors. Asian fintech companies like MetaPlanet have acquired 10,000 Bitcoin with plans to reach 100,000 by 2026. They're funding these purchases by issuing $210 million in traditional bonds, essentially using old financial tools to embrace the new paradigm. What makes this shift remarkable isn't just performance, it's accessibility and certainty. Government bonds require complex settlement infrastructure, intermediaries, and institutional access. You can't buy treasury bonds at 2 a.m. on a Sunday. You can't settle them instantly. You certainly can't verify their authenticity with mathematical precision. Bitcoin operates 24/7, settles in minutes not days, and runs on an immutable network secured by 913 exahashes per second of computational power. That's the highest security level in Bitcoin's history, representing a 77% increase from 2024 lows. More importantly, Bitcoin's supply is mathematically fixed at 21 million coins. No government can print more, no central bank can devalue it through monetary policy, no political crisis can compromise its integrity. This scarcity, combined with growing institutional demand, creates a fundamentally different risk-return profile than government bonds. The correlation data reveals why sophisticated investors are making the switch. Bitcoin maintains a correlation of just 0.2 to 0.4 with traditional equities and 0.1 with bonds. This makes it an exceptional diversifier, particularly valuable when both stocks and bonds face pressure from inflation and sovereign debt concerns. The sovereign bond crisis isn't theoretical, it's happening now. In May 2025, U.S. 30-year bond yields hit 5.15%, the highest since October 2023. Japanese 30-year bonds reached an all-time high of 3.185%, signaling unprecedented fiscal stress. These rising yields don't just reflect inflation concerns, they reflect growing questions about sovereign creditworthiness. When major foreign holders like China reduce their treasury holdings while increasing gold and Bitcoin positions, they're voting with their wallets against the old system. Bitcoin's response to this crisis has been remarkable. Rather than falling during sovereign stress, it's risen to new all-time highs. The asset that was supposed to be risky is now providing portfolio insurance against the failure of supposedly safe assets. Financial experts like Andre Dragosh from Bitwise point to Bitcoin's role as a hedge against sovereign default risk. Unlike government bonds, which depend on political stability and fiscal responsibility, Bitcoin operates independently of any government's promises or policies. The institutional adoption reflects this understanding. Pension funds, insurance companies, and sovereign wealth funds are quietly allocating to Bitcoin ETFs not as speculation, but as prudent risk management against the erosion of traditional safe havens. The shift from sovereign bonds to Bitcoin represents more than changing investment preferences. It signals a fundamental reordering of how we think about safety, scarcity, and sovereignty in an interconnected world. For over a century, the safest investment meant trusting governments to honor their promises. Today, the safest investment might mean trusting mathematics, cryptography, and decentralized networks that no single entity can control or manipulate. Bitcoin's superior Sharpe ratio isn't just a statistical anomaly. It reflects the market's growing recognition that artificial scarcity created by monetary policy is less valuable than absolute scarcity enforced by code, that political promises are less reliable than mathematical certainty. As sovereign debt continues growing and bond yields signal fiscal stress, this trend will likely accelerate. The institutions making the switch today aren't gambling on a speculative asset. They're recognizing that in a world of infinite money printing and rising sovereign risk, the ultimate safe haven isn't a government's promise to pay. It's an asset that needs no promises because it operates on proof, not trust. The great safe haven revolution isn't coming. It's already here. The only question is how quickly traditional finance will adapt to this new reality.